Hi, everybody. Welcome to this week's Fireside Chat. I'm Coburn Sheppick. Appreciate you being here. I hope you're having a fantastic week. In today's discussion, we're going to be talking about where distressed commercial real estate opportunities are found. So as you know, we're going through very uncertain times. The Feds have raised interest rates by 375 basis points now this year. And we still have potentially one more hike to go next month in December. And likely there's going to be continued increases into Q1 of next year, 2023. And so we've done a few calls here on the topic of distress, not to be pessimistic, but to provide education on what to look for, a recap on kind of how distress starts to appear and what it looks like. And today we're going to be talking about where potential opportunities are found as it relates to actual circumstances and where we will locate these opportunities and where you can locate them as well. So if you go back to some of our previous discussions on this topic of distress, we recently did one on how distress occurs, and that is basically lying on the capital stack and the basis of where operators acquire at. So happy to dive into this conversation today of where distressed commercial real estate opportunities are found. So a few of the topics that we want to cover, I want to do a brief introduction of Dovetail and a little bit about us, and then I want to talk about the state of the market, where we are now, and leading into from that is where these distressed opportunities can actually be located. So a little bit about Dovetail. Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. So we align with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. So we work with established and evolved investors who are attracted to investing alongside some of the world's best real estate operators and sponsors to insulate their wealth and reputation in this very uncertain world. So our focus is primarily on acquisitions and development in growth markets, mostly in the Sun Belt region, and our typical project profile is Class A, Core Plus, opportunistic opportunities, developments, and as well as the upcoming potential distress, which we think will unfold pretty dramatically over the next 6 to 12 months. Our average hold time is 5 to 7 years, which is pretty typical for our investment holding period. And the distressed category is, again, and we'll dive into it a little bit later on this call, but I want to highlight that where we are now in this cycle is, first of all, it's unlike anything that we've experienced before, not only in history, but especially in my lifetime, the people that are around me's lifetime. And I want to reiterate that these opportunities that'll present themselves in the coming months only happen once or twice, maybe a few times in a lifetime. And especially a cycle like this, where we've haven't had quite as much of a correction so we had the longest expansionary period pretty much in history. And we also, looking back at past cycles, the economic debt bubble is way beyond what it's ever been before. So to put that into perspective, we are currently at a nationwide have over $30 trillion worth of debt. And back in 2008, for example, we had about 10. And so the potential crisis dwarfs what has happened in the past. And we'll get into a little bit about that later. So state of the market, as we know, interest rates have gone up drastically this past year after being nearly zero for many years prior to the pandemic. And these rate hikes, just yesterday, the Fed raised rates another 75 basis points or 0.75%. That equates to a total increase of 3.75% this year, and which is the fastest rate of the fastest pace of rate increases in a period of time in pretty much history. So again, unlike anything that we've experienced in our lifetimes is currently happening now. But as we can see, if you're on this call and looking at the screen here, you can see, and as you know, that interest rates historically have been much, much greater than where they are today. So what does that mean? It doesn't mean much. It means that, for one, you could say that rates could continue to continue to go up even further based on looking at history. But the real problem lies in the values that have exponentially grown, especially over the past few years, and the acquisitions that have taken place over the past few years at unheard of cap rates in the 3s and early 4s, along with the low interest rates. So the pressure from the pace of these big jumps in rate hikes is going to cause potentially great distress. So inflation is obviously the reason for these interest rates. September inflation clocked in around 8.2. And again, we are not economists by any means. We are digesting this data to make assumptions for the future. So anything that you're hearing here, we're taking these facts and making our own assumptions, of course. So I want to just disclose that again. But inflation is at 8.2% as far as the CPI goes, which that means it's much more than that. And that's about 6 percentage points higher than the Fed's target of 2%. And so if we look back in history, in the late 70s, early 80s, where we had an inflation problem, this is, if anything, the most similar time to that era of the 70s, which then led to a recession in the early 80s. So now we are at a tipping point domestically and internationally as far as how the outlook is. And so some people might be asking, looking around, are we in a recession? Are we going into a recession? Looking at historically how we've established or defined a recession by 2 consecutive quarters of negative GDP growth, we are in a recession. Although this definition has moved into a gray area today because we're not in a recession. We're going on, multiple quarters of negative GDP growth. So the housing market, even though we're not talking about the housing market now, we're talking about commercial real estate. The housing market plays a huge role in our economy. And currently, there's a massive mortgage gap between the cost of renting the average apartment or the average single family dwelling versus the cost of the average mortgage. And so there's about a $1,000 gap right now. If we look back in history during 2007, 2008, the gap was around 700, 800, which we don't like this. The Fed doesn't like this. And so the goal by rising interest rates, not only bringing the cost of goods and services down, is to also bring the cost of housing down to where it fundamentally should be. And so people think mostly that owning a house is actually cheaper than renting. Well, not in today's environment. It's about $1,000 a month $1,000 per month more expensive than renting as of today. And so again, by rising interest rates, yes, in the short term, without driving values down and disrupting demand, it's going to continue to push the cost of capital up, of course, which brings the monthly rates up on a mortgage, and people buy not based on values, but the cost of the monthly payment. Aside from all of these, aside from this nation, we've got globally, we have big issues, of course, and with the war in Ukraine and inflation skyrocketing in other countries, this is affecting the U.S. as well. And so, for example, inflation in Europe is way beyond where we are in the U.S. because of the issues in Ukraine causing energy prices to skyrocket. And so with all this, we are at, even though they haven't called a recession yet, the NBER hasn't called a recession yet, we're at a major tipping point to be in a recession. And we currently have negative yield and all these red flags that have appeared that are pointing to a hard landing. And by listening to Powell speak yesterday, they want to continue this aggressive approach. Obviously, they just raised rates again by 0.75%. And the risk of a hard landing is becoming more and more extreme. And even in their words, the ability for a hard landing is definitely narrowing that ability. So with all that said, I want to dive into our topic today, which is where distressed commercial real estate opportunities are uncovered. Where can people find these opportunities? Where are we seeking these opportunities? And there's many ways, and we'll all start to see this as far as how these opportunities are uncovered. And we're already seeing the market tip, and not only through mortgage applications falling, layoffs, we're already seeing development deals on pause or abandoned in some cases because builders are at risk by not being able to sell these homes. So it's potentially less expensive for them to stop the projects while they sort of are in a wait and see kind of mood. And so starting with a potential area of locating these opportunities is discounted payoffs. These are from lenders, mezzanine lenders as well. And basically you can acquire these notes or from these lenders who want out of the deal or in a potential default scenario. Another case is in equities. I know that for sure in the markets that we're looking at, there's going to be major equity impairments of people, investors who have acquired or invested with operators who have acquired properties over the last 12 to 24 months with high leverage, short-term debt that want out. and there's going to be a lot of restructuring opportunities in these types of deals, and likely for the operators who are in those types of deals, potentially have other investments as well that they need to get liquidity out of to be able to protect themselves and service their debt, et cetera. You'll start seeing, which was popular after and during the financial crisis, and hasn't been such of a need, since then. But sale leasebacks will become popular again. We're already seeing them in the mainstream, and these are companies, usually net lease lessees that are in need of liquidity, and big box stores, industrial space, that are in need of liquidity, and there's an opportunity to take over those properties. And of course, defaults. And you can have access, anybody can have access to a notice of default list or an NOD, which is basically when there is a type of default, it's public record, and we can see when there is a notice of default, which happens after so many missed payments, and it's basically a notice to the borrower that they're going into default. And this will be we'll have this ability in bridge debt, traditional commercial lending, and the ability to provide DIP financing to these extreme circumstances where there is defaults. Trustees is another one. These are obviously individuals that have the ability to make decisions on the assets in their trust. And so they also are in need of liquidity, and they might have ties to other assets, and anybody in this environment is going to seek for liquidity, not only because of scarcity, but to remove themselves from the risk, as well as prepare for the opportunity that's to come. And attorneys is another one. Bankruptcy attorneys will have obviously the first kind of or the second understanding of circumstance of potential bankruptcies or defaults where people are in need of capital or in potential distress scenarios. So they've got clients, they've got a network. And lastly is just brokers and operators in general. These, just speaking on brokers, they're in the business of working directly with operators. And if an operator comes to them and shares that they're in need of something, we can be there to help in those circumstances. And operators who are also in the business not only have at least one property, they might have multiple properties in a potential distressed circumstance. So we're able to tap those networks and provide solutions for the potential distressed assets that are in their network. So these are some examples of where these opportunities can be uncovered. And we're at Dovetail definitely in this wait and see, wait for this all to unfold, because this has happened before. And if you look at history, and especially in the past few years, where the fundamentals have gotten flip-flopped and people are buying value add deals at 4.5 caps and using high leverage short-term debt, there is a massive risk for a lot of debt to explode. And we don't want to be pessimistic. We don't want people to get hurt, but the facts is that these opportunities are at huge risk, and we're already seeing this unfold. And it takes time distress takes time to impact major metros, because distress starts in secondary markets and works its way internally to large metros. So it takes time, a lot of time potentially, for this to really unfold and the opportunities to uncover. So we're waiting for this 375 plus basis point rate hike to unfold, and we're ready to take on this, again, once in a lifetime opportunity that we'll have to get in at a really fantastic basis. So if you are interested in learning more about our opportunities and how we're approaching this cycle, I want to invite you to schedule a call with myself or a team member. You can reach us at partners@dovetailig.com. Visit our website at dovetailig.com. Once again, my name is Coburn Sheppick. I appreciate you being on this call today. And we do these calls weekly, especially during this time where the market is moving quickly and there's a ton of uncertainty. So we hope these calls, can provide people great value, as well as build a potential relationship with you. And we can, potentially work together to capture this, again, once in a lifetime opportunity. So thank you again. We'll look out for future emails for our upcoming calls. I hope you have a fantastic week. Cheers, everybody.